What are the risks for an oil super spike? And why is the escalation ladder so important here and now? Welcome to a monthly contribution on behalf of the Foundation for the Study of Cycles with myself, Ron William, Development Director, at a very thematic and timely moment, following on from the last theme of 2026 cycle convergence. Here and now, we are truly seeing history in the making, and of course, global affairs, volatile and uncertain. And the big question is, how can cycles help us navigate through this uncertain time? So to help answer some of those questions, as always, we'll be doing a comprehensive deep dive, and the key areas will be market signals in terms of the crowd psychology, sentiment, and various indicators, oil super spike scenarios, and how does that align with the geopolitical macro changes, both on a domestic Iran level as well as the global changing order that is taking place. And then lastly, the bottom line, actionable trade insights that many of you will be keen to hear about in terms of energy stocks, commodities, and just final key insights. Now, for those of you who would like further education resources, just look to the right. There is a media interview with Real Vision that was hosted on geopolitics and how that is impacting the business cycle. That's available for those of you that subscribe. Otherwise, shoot me a note here at the FSC and I can send you through the guest link. And then also keep in mind that there is a special report write-up freely available on my Substack account, ronwilliam.com. Let's begin with market signals, volatility regime. One of the most important signals that gave a lead indicator, and I emphasize lead indicator over price and over the headlines themselves, was volatility. And this is something I spoke about exclusively with the FSC Master Working Group some time ago. But of course, with things fast changing, both headlines and markets, I've needed to update the data and give you the latest context as to how things have changed, all sentiment driven. Now, the opening chart is sentiment, looking at trading odds using polymarket data, and you can run this across various thematic market or macro themes, including geopolitics. And you can see here, the data we're looking at is basically the probability of a ceasefire between now and end May between Iran, US, and Israel, and of course, the broadening conflict in the Gulf region, as well as the global economic impact that we are all now experiencing. So this is showing that the global energy market is undergoing a rapid repricing as geopolitical tensions between those nations escalate. Within just the last 7 days, literally and counting, prediction markets shifted from pricing in 85% odds, you can see there on the top left-hand side in green, for a near-term ceasefire to less than 50% by end May. This signals a transition into a new high volatility regime, which is where we are now, where prolonged conflict risk here for the moment is the new base case. The shift unfolded in 3 phases. You can see there the traffic light coloring from green, amber to red. Green being the initial optimism when Trump said the war could end in 4 weeks. Then brief diplomatic narrative shifts in phase 2, signaling a potential ceasefire interest. And then, of course, things changed pretty quickly in phase 3 through escalation, where Iran denied that ceasefire claim, and very soon after, US military forces attacked it, Kark Island. It's a key energy hub island in the Strait of Hormuz, which many of you will know as being a key choke point for global energy. About 1/5 of global energy runs through that area, and while it's not strictly closed, traffic has stopped, and certainly insurance premium has jumped up. So we can just see there, just looking at sentiment based on trading odds for ceasefire ending by the end of May, dropping dramatically as things moved fast just in the last 7 days. Now, one way that you can actually look at this, and this was the chart I was originally alluding to early on in the year, before this geopolitical situation and prior military strike actually took place, we could see it in the volatility markets, which were leading price and not the other way around. Remember, volatility is not just a volatility indicator, which, yes, does measure fear. It also highlights options, positioning, and hedging in the market, which typically has a forward look back sensitivity. So here we see the ticker for this, by the way, is OVX. For those of you that want to look it up on your chart platforms, TradingView has it available. A change in regime which surged to the 120 level, that big straight line rocketing up, in line with our projected target. You can see the technical projection from the prior volatility regime to the new one. And essentially, it is now reflecting crisis level conditions, implying a plus or minus 35% monthly swing on the oil market. So yes, it's asymmetric upside, but it's super volatile. And certainly we need to be astute with our tactical and risk management. More importantly, the options positioning suggests institutional hedging of extreme outcomes as well. So that's adding further reinforcement. Call skew, for those of you who look at the options market and sentiment measures, is rising relative to puts, with growing option interest in deep out of the money calls within the $150 to $200 range, which is the super spike risk that we are now needing to reflect on as a clear reality. The term structure of volatility reinforces persistent demand for tail risk protection. So certainly, whether or not things resolve in the near term, best case, or we are given some level of peace of mind stability, the market impact is still in, and certainly it's pricing worst case scenario still. Now, if we try to add historical context to what is deemed an oil spike, there are many examples of historical precedent strongly supporting the plausibility of such outcomes. This is a long-term inflation-adjusted chart of oil going all the way back to the 1970s, and it shows that major oil spikes have consistently occurred during periods of geopolitical conflict and systemic economic stress. And for those of you cycle lovers out there here watching our FSC special monthly contribution, yes, there are cycles down below. I'll get to that in a moment. But the key insight on this chart is the real price perspective. It's showing you that in inflation-adjusted oil terms, i.e. when comparing apples for apples and ultimately adjusting for the changes of inflation, we have seen 150 to 200 plus oil in prior crises. Now, from a cycle regime perspective, there's 2 points to highlight. One, there is a cycle beat, as we can all imagine and expect. We are currently mid-cycle structurally in terms of here and now, and that's based on a combination of a long 12-year cycle and short 3 to 5 year cycle, which acts as a fractal of the former, pointing to a 2026 inflection point here and now. Now, the second part of this is the behavioral pattern. Stay alert for the historical echo pattern from the 1970s, which displays a two-part shock, not one, but two. If you look at the left side of the chart, you can see first shock in 1973, Yom Kippur, the Egypt-Israel war, that then led to a consolidation for a while, and then a second shock in 1979 during the Iranian Revolution. Thereafter, we had the Gulf War, the global financial crisis, but what you see on the right side of the chart as part of a two-stage historical echo pattern of the former 1970 regime, another potential two-stage pattern, one into the Russia-Ukraine war of 2022, and here and now, the early stages of what may prove to be a super spike risk to the upside in this US-Israel-Iran strike, and not just the strike itself and the broadening conflict, but actually the energy infrastructure damage that is being caused first in Iran, and then a quick pro-Crow counterstrike in related proxies which is clearly leading to an escalation and a spiraling and a direct energy impact, which is being priced for further upside in terms of oil spike risk. Now, headlines aside and event risk aside, the chart behavior is already signaling this along with the timing. And we know that, many of us who are doing this work on a regular basis and have seen certain things show up as and when the charts and timings line up, know that to be true. But here we truly do get the perfect storm of factors appearing in parallel. Let's shift now to the second stage, looking at the oil spike scenarios. So for those of you that want to think about event risk in a more deep and meaningful way, and what it means in terms of geopolitical macro changes, both domestically in Iran, and I'm going to speak objectively and apolitically, as well as globally in terms of the changing world order that many of you would have heard about, especially through popular works of Ray Dalio, Changing World Order, and Fourth Turning through Strauss and Howe's authorship work. Now, one of the diagrams which is very useful that I've been using for years for my own trading, investing, and also for client engagement is tail risk analysis essentially, but using various mental maps that can help us map out each of those scenarios. Scenario planning is ultimately what we're doing, but we're looking at it on the risk side. And so here, the map that we're using is an escalation ladder. And we've heard that term quite a few times just in the latest flurry of headline news that has been going on in the last few weeks with this geopolitical changing event profile. But essentially, it's a ladder with risk that escalates. And what's most important here is we can see right at the top, or I should say at the bottom, the market continues to only be pricing in the risk premium of geopolitical uncertainty at $100 to $120, when in actual fact, things have fast-tracked in a heartbeat all the way to the top of this escalation ladder, which is the right side of the tail risk, i.e. the worst case outcome so far, which is regional infrastructure attacks, first in Iran, then in related proxies, specifically the Gulf energy region. So any of you thinking about the energy shock, how does it compare to past times? If we look at the prior chart, you can see there we've had energy shocks in the past, but keep in mind this is the biggest in history, and that's not according to my view, but the International Energy Agency, the global experts in this field, have said this is the biggest energy shock ever. And they're not just saying that because the Strait of Hormuz is disrupted, but now we're getting energy field disruptions both locally in Iran and across the Gulf. So it's not just the choke point of Hormuz and one of the top oil producers in the world, Iran. It's the entire Middle East region is now disrupted in terms of not just geopolitics and everyday people and their everyday lives, but more specifically, the energy market itself. So when we're looking at energy shock and how it compares to past shocks, there are very few and potentially none for us to use as a benchmark measure. We are truly in uncharted territory here. And so we really need to have an open mind and a lateral thinking in terms of some of those risks and how they can escalate. I really want to emphasize that point because we often look for references. That's a useful thing as providing some sense of heuristic or even kind of a line in the sand as to how big or small the risks might be. But sometimes in life and markets and certainly geopolitics, we just have very new regime event risks that set a whole new baseline for us here and now and in the future. Now, if we go back to the oil super spike scenarios, that escalation ladder that we were just referring to, latest headlines pointed to the potential Iranian counterstrike, which has already happened in the Gulf energy infrastructure, reinforcing why scenario planning is key. provides potential paths waves. Let me just run through them. Current pricing reflects geopolitical risk premium in the 100 to 120 range, which is basically the baseline geopolitical uncertainty. However, shipping disruptions have already pushed towards a risk of 120 and perhaps in the near term 150, while disruption Strait of Hormuz could drive prices into 150, 200. We haven't seen we've seen the disruption, yes, in Hormuz, but we haven't seen 150, 200 yet. And more specifically to the original point I was making, we're now in the extreme scenario involving regional infrastructure attacks while this is currently active. So we could see 150 to 200 or more as part of a super spike scenario. Markets remain anchored. Right now there's a gap. Markets remain anchored to the base case, but the right tail is being repriced as we speak. So by the time you guys watch this live on YouTube, things could change. But certainly look at this as an educational resource in terms of the mental map for understanding how to manage risk, but also to prepare for various risk scenarios. And keep in mind that right now there's a gap in terms of what the market's pricing in and where the right side tail risk exists. And if that continues, then we could see a snap back and a super spike. Now let's shift gears into geopolitics, and specifically local geopolitics in Iran. There are cycles, as we know, in life and markets, but also in geopolitics. And specifically here, we're looking at geopolitics locally, domestically in Iran. There is an average of a 35 to 37 year cycle cadence in Iran, which does apply to other countries like Russia, socialist, communist regions of the world, but specifically those two countries. And we can see here a potential political transformation that was being signaled ahead of time into 2026. Remember, this is a long-term chart that goes all the way back 100 years. And you can see it encapsulating every time we pass that kind of midpoint level, key inflection points in the Iranian country for the Iranian people. Now, again, I'm going to keep this subjective and apolitical, but what's really important about these cycles is you get a combination of forces. And the one that I'm going to allude to is the 1953 inflection point, where ultimately there was an intersection of internal crisis in Iran, external interests. Remember, Iran is a big oil producer with lots of rich resources. And through the nationalization of Iran's oil industry, that then followed by a coup d'etat that reshaped the country's political trajectory for decades after. Now, here and now, across the modern era, Iran's political development has moved through cycles of legitimacy, strain, rupture, and institutional consolidation. The one data point that is an outlier is 1979. We know that's the 1979 revolution, and that represented the most dramatic transformation in this pattern. It is an outlier. It's not part of the 35 to 37 year cycle beat, but it certainly is part of the pattern. And that did reset things for here and now. And what we see in the current setup of 26 and the future development of it, as it is work in progress being developed, today's several forces appear to be converging: domestic legitimacy pressures, energy security competition, which kicked off with the Venezuela, not Iran, and now we have both potentially running in parallel, as well as intensifying great power rivalry. Now, while cycles do not predict events entirely, they do certainly help us navigate through them and better understand the context on a system level as to what is happening and potentially why. So I'll leave that reflective thought with you on this chart. Any questions, please write comments on the video. I always look forward to reading them and commenting back, or just shoot me an email at the FSC. There's so much to cover, so I'm just fast tracking through it in the time that we have, hoping that this can provide further insights for each of you after the session. Now, that was the local domestic cycle for Iran, which is clearly relevant here and now. But keep in mind, everything is in a constant state of flux, and it's not just domestic, local geopolitics, it's also global as well. That so-called changing world order popularized by Ray Dalio in his book, published some years ago, there's a reality check that comes with that. And you can see here the actual roadmap that was drawn by Ray Dalio in his book. You see the big picture on the left, showing that the reality of a changing world order remains key. And according to our work, it suggests that the 2026 cycle convergence, which I spoke about last month, is accelerating that process. And right now we're talking about big power, superpower, hegemonic regions of the world, specifically USA, with a global reserve currency status. So in prior cycles, it was the Brits and the Dutch, and you can go back several hundred years and find additional hegemonic currency reserve powers that were successful at what they did, innovated, grew, but also overstretched, and in doing so, developed the patterns of a cycle, but on a much larger scale. And you can see there the peaking out and the unwind of the cycle leads to is typically weighed under by debt, printing of money, internal conflict, not just external but internal, marginal loss of currency reserve status, and ultimately weak leadership that typically shows up over time, which creates that self-feeding spiral play-by-play development. And then often we get geopolitics kicking out in terms of civil war risks, revolution, as well as war. Now you'll hear a lot about geopolitics from the FSC in the coming weeks and months, because clearly it's thematic and timely. Look out for the video from our chairman, Dr. Richard Smith, and board member Andy Pincholi on war cycles. I'll also follow up with a special bonus video just on this subject soon. So just look at these multiple structural forces which are colliding: debt saturation, limiting policy flexibility, rising internal political constraints, external power competition, credibility pressure on institutions, and just recently in terms of increasing tariffs, sanctions, industrial policy, all as fiscal tools. But what this shows is a late-stage hegemonic regime where the rule of legitimacy gradually gives way to the rule by leverage, financial, political, and military. And we've seen this throughout history. It's not just here and now. And the critical signal from 2020 onwards, and you can see there on the bottom right-hand chart, looking at economic growth, GDP in pricing parity data, crossed over in favor of the BRICS nations: Brazil, Russia, India, China, and South Africa, which has since changed, over and above the G7. So not just the USA, but the G7, including the UK and Europe, as well as Canada. So many of the Western powerhouse economies are now surpassed by the BRICS nations. That is nature taking its course in economic and in cycle terms, but also that suggests a potential shift from unipolar to multipolar system, which we've already been seeing since then. You can see that in the crossover chart based on hard data. But what we're seeing now is the geopolitical contributing factors to that, where ultimately this gets stress tested, particularly in terms of the relationship between Iran and other BRIC nations such as Russia and China. For those of you who are reading the headlines and know a little bit of geopolitics and also about this shift into multipolar system, you can think more on that. Okay, so let's close on actionable bottom line driven trade strategies, and what this all means, not just to oil or even the geopolitical risk in Iran vis-a-vis US and Israel and the region, but more specifically as part of a broader commodity super cycle, which is definitely something that is on all our radars, and we can continue to benefit from in terms of either hedging or trading and investing. So the big news, which I hope everyone watching this already knows, because it's been a profitable and strong run, has been energy. And this is before headline news, before the military strikes, before geopolitics became an even bigger thing early this year. Energy stocks have been outperforming. This is since 2020, actually, but they did go sideways for some years thereafter. And it's this year alone, in just 2 months that have passed, now 3, we have had a plus 35% year-to-date outperformance of the energy sector based on an ETF with the ticker XLE, for those of you that want to use it as a proxy. There is further upside ahead. If you're looking for a target, the initial one is $65 and potentially higher to go. And the educational guidance here is to think about smart diversification. So continue to add further exposure based upon the bullish technical and cycle setup on commodities in general, but specifically in energy. Energy, you can triple up as part of a multi-layered portfolio diversification, first in underlying oil, but take care of the volatility. Your tactical analysis and risk management will be key. And then also you can look at sector ETFs, and then finally single stock equities as well. Okay. Remember this, the bigger picture is a commodity super cycle at play. I've been watching this setup for some years now, and it's a real experience to actually see it play out before your eyes. Cycles in action, but also market rotation from paper assets to hard assets, which is basically a late cycle signal in its own right, as financialization peaks out, the greed trade unwinds, and we rotate into fear assets, which are typically scarcity and inflation driven. That's ultimately what paper to hard asset rotation means. Now you can see that chart in the top right hand side, compressed, just showing a generational rotation between paper assets and hard assets. When that line goes down, commodities is underperforming equities, and right now where commodities is super oversold versus equities, and it's creating an elastic band effect, which sooner enough will snap back in favor of commodities. And that's what we're already seeing in terms of precious metals outperforming. Now you can see the chart on the left, the big one, showing rotation in action, but in a sequential fashion. Gold leading based on monetary stress, copper confirming late cycle pressures, energy more specific to here and now, supply shock and geopolitical rising tensions. And then the next one to follow, which is just about to activate, food inflation, specifically agricultural prices rise as inflation reaches consumers, and historically sharp increases in food prices have coincided with social unrest, protest, and political instability, particularly in economies already facing widening inequalities. So it's definitely something to keep in mind in terms of the socio-economic and the geopolitical dynamics changing over time soon, but also potential trading and investment opportunities as part of this broadening pattern. And then keep in mind the commodity supercycle echoes the 1970s style of inflation as structural supply constraints collide with rising global demand, potentially stagflation here and now with slowing growth and higher inflation as growth gets hit, particularly by the energy shock. And you can see that historical paradigm in the bottom right-hand chart, where we can see US CPI in red, rolling waves of inflation volatility over a decade, which matches the current pattern that we're seeing in CPI here and now, with a resurgence likely ahead. And this is already hitting the data points as we speak. So do expect higher for longer this year, 2026, and likely beyond. Now to wrap, key insights: ceasefire odds collapse from 85% to now sub 50%, with markets now pricing prolonged Iran, US, and Israel conflict, which has clearly been broadening out to the Gulf region. Oil in crisis volatility regime with the fear index OVX at 120, with large headline-driven price swings expected. Remember, it was about 30 to 35% up or down. Asymmetric upside in oil expected, but think scenarios 100 to 120 is the base, which is actually lagging here and now in terms of the event risk that is taking place, all the way up to $150 to $200 super spike territory as escalation scenarios further extend. We'll see if they do, or if best case we get a resolution unexpectedly. This is clearly impacting the markets. Energy funds up 35% year to date, just 2 months or so, signaling strong capital rotation to energy. And then just to keep in mind, the setup is consistent with a late cycle commodity surge and a potential super spike. Risks extend beyond oil into inflation, food prices, and social instability. So that's the deep dive, comprehensive review of where we are right now in cycles, markets, but also macro. Best success in navigating this 2026 convergence, challenging times ahead, and certainly uncertain and volatile in market terms. So best success with all that you do. If you want to stay in touch with myself, from William, on behalf of the FSC, feel free to contact on the details displayed on the slide, or stay in touch via social on LinkedIn. Remember, in addition to my responsibilities at the FSC, I also trade myself, use cycles as part of that approach, and advise institutions. So this is very much part of what I do, as well as the education work, which is really important for awareness and for helping us to navigate these changing times. Thank you. Welcome feedback and questions, and certainly any comments in the section of the YouTube video. We always appreciate. Remember to like, share, and subscribe. I look forward to contributing further insights in future episodes. Thank you very much.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
Foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.